Hello, this is Rob Beardsley with Lone Star Capital. Today I want to talk about the recent public market volatility and how that relates to private real estate. So, been seeing a lot of Facebook posts, mainly real estate sponsors, investors talking about how, I'm really glad I'm not invested in the stock market. Look what's happening there. Prices are going down 20, 30%, and my real estate portfolio hasn't gone down at all. And just because that your 200-unit apartment complex doesn't have a ticker symbol doesn't mean that the value hasn't changed. One thing's for sure though, the private market, especially something illiquid like real estate, the prices reflect the fundamentals much more slowly. If we do experience a recession due to prolonged impact of the coronavirus, then we will definitely have a pricing discovery period where real estate prices do go down, similar to the public markets. But because the public markets are liquid and they're traded every second of every day, they're quick to reflect perceived future fundamentals. But I definitely want to say that, in my opinion, our real estate portfolios, mine included, is absolutely not immune to the market shocks and things that are affecting capital markets right now. There are many things that are affecting real estate, not just the potential for job losses of our tenants, but also the way the capital markets are functioning right now. We've seen an extremely volatile 10-year and spreads are even more volatile. So if you're not familiar, the cost of borrowing for real estate is reflected by an index rate, which if you're borrowing long-term financing, that would be mainly the 10-year treasury, and then also a spread or a credit spread, which would be put on top of the 10-year, your base rate, for an all-in interest rate. And so spreads, because lenders are uncertain, are even more volatile than the 10-year. And the 10-year is traded by bond traders and investors, and that's volatile right now because people are potentially trading out of stocks into bonds due to a flight to safety and a risk-off mentality in the market, which is lowering bond yields. But then we saw them trade all the way up from 50 bips to over 1%. All that's happening, and meanwhile, spreads are moving in the same direction or in the opposite direction. So it's really hard to tell, and it's affecting our ability to borrow for real estate transactions. So that's really slowed down transaction activity. We've seen deals fall apart due to either equity investors or lenders. Effects are taking place today in the real estate market, even if prices necessarily haven't changed substantially like the public markets. But if real estate prices do change, it's likely to occur over the next 3 to 6 months, and better buying opportunities will be available then. So while I don't believe in the immunity or recession-resistant claim about especially Class B, C multifamily, there are some benefits to owning illiquid real estate. And the benefit is the illiquidity itself, because there are high transaction costs involved with buying and selling real estate, and there's a lot of things that need to be done: investment committee approvals, lender approvals, third-party reports. There's a lot that goes into these transactions, so it's much harder to impulse buy or impulse sell. Unlike the stock market, it's really easy. Go on your phone, go on Robinhood, execute a trade in a second. So if you get nervous or you're watching CNBC, you freak out and want to sell some of your stock portfolio, it's very easy to do so, but it's harder to do that in illiquid real estate. And that's why you see prices, they don't just immediately plummet, because a seller has to realistically look and say, hey, does this make sense for me right now? And there's more clarity of thought with illiquidity. So that's something I really like about real estate, because it forces you to make better decisions. The other benefit is cash flow. Not just cash, but cash flow is king. And that's another great aspect of owning private real estate, which is, even if valuations do go down materially, and let's say you had a property that you were hoping to sell for 20 million, but from some market collapse, it's only now worth 15 million. But let's say your NOI has only marginally been affected, you can hang in to that deal and continue to cash flow. And there's no reason to sell, because you're able to survive off the cash flow, and the investment's able to survive, pay its debts, kick out a decent return to equity investors, and wait for the market to return to normalcy, or back to, even you might have to wait 1 year, 2 year, 5 years to wait to get back to a nice market high. But eventually you'll be rewarded for having the patience to hang in there and wait until valuations become more favorable. And you wouldn't be able to have that patience and resolve without the cash flow. So that's why cash flow is king. and coupled with illiquidity, really make it for a better opportunity to realize a more positive outcome rather than trying to buy and sell in and out of market cycles. The goal, as everybody knows, is to buy low and sell high. But human psychology leads us to buy high and sell low. We get excited when prices are moving up, we get in, and then prices become depressed, we get upset and we sell out. So to combat our broken human psychology, rather than trying to work with it, just remove human psychology out of it with the illiquidity nature. So those are my thoughts about the current market volatility. I'm currently in Texarkana, Texas, practicing some social distancing, and I hope you stay safe.